Hello, and welcome to Retirement 101. Now, if you're taking this webinar, it's because you're interested in learning about the steps that you need to take in order to prepare yourself for retirement. The things that you need to do in order to start saving, start learning, and start planning for the future. I'm Sean Lee. I'm managing partner here at Elevated Retirement Group, and I'm going to spend 30 minutes walking you through Retirement 101. Now, what are we going to speak about today? We're going to talk a little bit about your retirement planning options. We'll talk about the 3 different asset classes that you can invest your money in when it comes to planning for your retirement. And we'll talk about the power of dollar cost averaging and how dollar cost averaging in decreasing markets can actually help your plan. A little bit about my background. I've been an advisor for over 20 years. Like I said, I'm managing partner here at Elevated Retirement Group. And my job over the next 30 minutes is to educate you on these 3 main areas. And if you choose after the webinar to speak with a member of our team so you can get some more clarity, so you can start the path of planning, so you can get a good understanding about what those myths, misconceptions, emotions, and options are when it comes to planning, we'll give you the opportunity to have a 15-minute call with a member of our financial planning team. So with that being said, let's look at some key facts. Now, the total U.S. personal savings amounted to over $800 billion as of April of 2023. And that personal savings rate was around 4.1% for the average American. Surprisingly, that if you take retirement assets out of it, the average American only has around $65,000 in personal savings, which doesn't necessarily protect you from the unknowns. Do we have an emergency, or is there an unknown cost that's going to come to us? So making sure that we have enough assets saved to get us through the storms outside of our retirement assets is extremely important. Now, what we're going to talk a little bit about is creating a process to filter out misconceptions, misunderstandings, and emotions. See, there's so much news out there, whether it's economical or political or social. You can go to the internet and you could Google an investment strategy and you'll get 8 billion hits in a matter of seconds. But a lot of people don't have a process to filter out myths, misconceptions, misunderstanding, and emotions to help you make decisions that are based on facts and logic when it comes to your retirement planning. So let's start with the 3 asset classes. Now, 3 asset classes, you hear it a lot. I should be diversified. I should have my money in different areas, which is true, but diversification and asset allocation are 2 different things. Diversification is a silo of asset allocation, where asset allocation is focusing on all of the main asset classes that you could invest your money in and diversifying through those asset classes. So what do I mean by that? Well, the first asset class is your cash class. And that's going to be your savings accounts, your checking, your money market, your CDs, and your what are called treasury bills. Now, historically, this asset class, this cash class, had a very low rate of return. But you were willing to give up return because you had safety of your money and accessibility, which is liquidity of your money. Now, in today's marketplace, that looks a lot different now than it did even a year ago. So a year ago, 2 years ago, what did we see? Interest rates were at 0%. You couldn't earn anything in these types of accounts. Now, as we sit today, you can see savings rates, whether it's at your bank or your credit union or online custodians, online banks. You can get a rate of return anywhere from 4 to 6%. Pretty good for safe money that's going to be liquid and there when you need it for emergencies. As we move over to the next asset class, that's the income class. Now, the income class has three main areas in the income class. You've got bonds, which are individual bonds. You've got bond mutual funds, and you have what are called annuities, which we'll talk a little bit about annuities here in a second. But what is a bond? So all an individual bond is a promise to pay. It's an IOU. So either the government or a municipality or a corporation, they say, hey, we want to build some roads. We're going to issue bonds and we want to borrow your money. Community, we want to borrow your money, and we're going to, at some point in time, we're going to pay you back your principal. Now, this is a predetermined point in time, but they're required to pay you back your principal. Oh, and along the way, we're going to pay you some interest, whatever is agreed to in that particular bond. So it can be seen as an income source for you if you choose to use that money as income. And then the other area are bond and mutual funds. So what is a bond mutual fund? All a bond mutual fund is a basket or a grouping of a lot of different government bonds or corporate bonds or municipal bonds, all packaged together, professionally managed. So you don't have to decide which bonds to buy or sell. Bond mutual funds are store-bought. You can go out and you can buy the bond fund, and you really don't have to worry about the management of it. You pay some fees there, but somebody else is managing it, and it's really simple to do and allows you to get some diversification through all these various areas. The third area in income are annuities. Now, there's a lot to unpack when it comes to annuities. There's good, there's bad conversations around annuities. What we're talking about here specifically is one type of annuity. There are many types, but we're talking about fixed annuities in the income class. And fixed annuities, what they do is that they look and smell a little bit like a CD, but they're going to guarantee your principal. And because you name beneficiaries, it is an insurance contract, you avoid probate. There are some liquidity options, but annuities are timed deposits, so you can't get your money out within certain restrictions. You get pretty competitive interest rates. What we're seeing in the open market right now are fixed annuity rates are a little bit higher than CD rates. That's the norm. And there's no entry fee to go in. And if you have after-tax money, that money grows tax deferred because annuities are considered retirement accounts. If you put after-tax money into an annuity, you can't get access to those funds prior to 59.5 without penalty. So it's really important to understand where you're investing and why you're investing in certain areas. And the last area that we look at are equities. Now we're saying, I'm an owner of something, I'm not lending money to you. Much like with the income and bonds and bond mutual funds, you were a lender. Now inside of equities with stocks, stock mutual funds, real estate, gold and silver, you are an owner. One of the most widely known companies when it comes to stocks right now is Tesla. Elon Musk is all over the news. Tesla is kind of a cool car, cool story. But if I went out and I bought one share of Tesla, I was an owner in that company. And so if Tesla's stock price continues to go up, that's great. I get to see growth in that share of stock. And because stocks have historically outpaced inflation, it can be seen as an inflation fighter for you. Now we go down into stock mutual funds. Now stock mutual funds are much like bond mutual funds. In stock mutual funds, they invest in a basket of individual stocks. They're professionally managed. There are some fees attached to it. But now they're going to focus, rather than government, municipal, and corporate bonds, they're going to focus on large companies, which are the big boys, the Microsofts, Pfizer's, Home Depots, medium-sized companies, which are companies that are a little bit smaller but still well-known. We're going to focus on small companies. They're going to focus on maybe some international. And so they're going to focus on certain areas, large, medium, small companies, international companies. Maybe there's a specialty mutual fund that's got different sectors in it. but they're there to be professionally managed and have a basket of individual stocks, so you don't have to focus on which stocks do I pick and choose. Once again, they're store-bought. What I mean by that is that you can go out to Fidelity or Vanguard or Schwab or whoever it may be, find your fund that you want to buy, and go ahead and just buy it. The next equity asset class is real estate. So real estate is considered an equity because you are an owner in that property or land or building or whatever it may be. And then you've got gold and silver as well. Now, when we look at the asset classes, it's important to remember a couple of things. One, diversification is diversifying through just one asset class. So equities, for example, if I'm going to diversify through equities, I'm going to buy large companies, medium companies, small companies, international companies, whatever it may be, maybe some, a little bit of real estate or some gold or silver, but I'm only diversifying through that class. Asset allocation is diversifying through all asset classes and having diversification in each. So maybe you've got some different bond holdings, you've got some different equity holdings, and you've got some cash to go with it. Now, the important part about that is that we want to make sure that we've got access to all different asset classes, so you can ensure that your plan is built uniquely to you and your needs and your comfort level with risk and what's associated with the ups and downs of the market. So let's move on to the different retirement planning options. And really, when we start to look at the different planning options, we look at different buckets of money. Where are different areas that you can put your money, right? You work hard for your assets, you work hard for your dollars, and as you're saving, nobody cares more about your money than you do. So when we start to look at that, we have to understand that if we're going to save our money, we want to make sure that we do it strategically and efficiently. So once again, much like the different asset classes, we have three different buckets of money where we could place assets. The first bucket is taxable. It's our after-tax dollars. That's your checking, your savings, your cash, your CDs, what's called a non-qualified brokerage. So if I go out and I open an investment account with after-tax money, and I'm buying mutual funds or I'm buying bonds or stocks or whatever it may be, that's considered a non-qualified brokerage account. Now, with these accounts, it's important to remember that interest and dividends are taxable in the year that they're earned. So if I earn interest and dividends in 2024, I'm going to have to pay taxes on that for 2024 when I file my taxes in 2025. Then we move along to the center, and that's your tax-deferred money. Tax-deferred means that I get a tax deduction up front. So I get a reduction of my tax return. My money grows tax-deferred for me, and I'm not taxed on that money until I pull it out, usually in my retirement years, age 59 and a half plus. And what are the choices there? Well, you've got 401k options. If you work for a city, you probably have a 403b or a college or school. You could invest in a traditional IRA, a SEP or simple IRA if you're a business owner, pensions, and qualified retirement plans. The important thing to remember here, though, is that when the money comes out, it's taxable to you. So you get a tax deduction on the front. You don't pay any taxes while the money grows. But when you start to withdraw funds, then you're taxed. And the last bucket is tax favored. Now, when we start to look at the difference between tax favored and tax deferred, we're looking at taxing money early. So if tax deferred is we're taxing the harvest of our money after it's grown and we're taking it out. Tax favored is we're taxing the seed of our money. So we tax the seed of our money, the money that we put in to the account is after tax. It grows tax deferred, and then it comes out either tax free or tax advantage. So you don't pay any taxes on those withdrawals. In that tax favored bucket, you can invest in Roth IRAs. If your 401k has a Roth option, you can invest in a Roth 401k. Municipal bonds usually have some form of tax advantaged benefit to them. And life insurance as a retirement plan usually have some form of tax benefits attached to them as well. But when we start to look at where we can invest our money, the different asset classes, and then the types of tax buckets, it's important to work with a professional to understand, okay, what is going to be the best tax bucket for me? And then where should I invest my money as far as what asset classes should I put it into? And that's where our team can really help you. But even in just a 15-minute call that you have access to with our team. So let's talk quickly about dollar cost averaging. And this is important to understand why dollar cost averaging is so important. Why it is vital to understanding the power of consistently investing your dollars. So if we look on the screen, and I'm going to have you get a little bit of math out, and I'm going to grab my trusty calculator right here as well, and we're going to talk a little bit about what dollar cost averaging really means. So dollar cost averaging is all about, consistently investing regardless of share price. And so we've got client A and client B. Client A they saw their accounts continue to go up throughout the course of the year. Client B actually saw the stock prices go down and then just come back to the normal price, right? So it started at $5 a share, ended at $5 a share. So it really didn't earn a whole lot, didn't earn anything on the surface. Client A started at $5 a share and went all the way up to $10 a share to end the year. So on the surface, you'd think, wow, client A made more money. They doubled their money, which may or may not be true. Let's run the math to figure it out. So when we look at client A, and you can see on the screen, they bought 20 shares the first month, 17 shares the second month, 14 shares, 20 shares, 17 shares, 14, 13, 11, and 10. So what you can see is that as their account value went up, they only were able to buy, what a certain amount of shares. So if they're investing $100 a month, as stock prices go up, they're only able to buy, 10 shares if the stock price is $10 a share. Whereas when it started the year, stock price was $20 a share, and they were able to get, or $5 a share, and they were able to get 20 shares. So at the end of the year, they had 174 shares. Client A did. Client A had 174 shares at $10 a share. So they had $1,740 in their account. Sounds great, right? They made money. They did not make they didn't double their money, right? They made some money, but they didn't double it because they were buying shares along the way. And unfortunately, as time went on, they were getting less and less shares. So I'm going to write that down. We got 1,740 shares. Let's look at client B. Client B then invests, and they went through a tough time, right? The markets went through a painful time. So now they bought 20 shares to start. The stock price went down to $2.50, so they got 40 shares. And then it went up, they got 33, and then they got 40. And then it really plummeted, and they got 66. And then they got 33 again. Then they got 25, and 33, and 35, and 40, and 25. And then finally 20 shares. So client A, they have 174 shares. Client B has 410 shares because as the stock market was correcting, they were able to go out and pick up more and more shares with the dollars that they were investing. So $410 a share times ending balance at $5 a share. Who do you think wins? the client who had 174 shares at $10 a share, or the client who got 410 shares, client B, and the ending price was $5 a share. Client B had $2,050 in their account at the end of the year. So when we start to look at dollar cost averaging and investing consistently, depressing or decreasing markets are potentially a good thing because you can pick up more and more shares along the way. The key here is that we're going to have up years, we're going to have down years, but we need to have consistency when it comes to our investing, right? We need to have consistency where it comes to putting money away, whether it's in your IRA, whether it's in your 401k, 403b, TSP, it doesn't really matter. Consistently putting money away is going to benefit you in the long term. But it all comes back to what are you trying to accomplish inside of your plan, right? And so when we look at that, there's the numbers that were attached to it: $174 a share, 174 shares, $10 a share, $1,740 versus $2,050. On the surface, client A looked better. It's not the case. Client B actually won out because of the depressing stock values middle of the year. So what can we do? Now, here are your action items in taking the steps to getting you to where you want to be specifically for your situation. First and foremost, go out and create a budget. And there's a couple of ways that you can do that. You can go out and you can say, you know what, here's my budget. I'm going to write it down. Here's all my expenses. That's a good way to start. The second way to start, or the second option that I would recommend is sit down and go ahead and pull your bank statements for the last 12 months and really get a good handle on what you've spent. Your bank statements won't lie. They'll tell you exactly what you spent over a 12-month period. From there, if you choose to, go meet with an advisor or go meet with a couple of advisors and gather information to make a fact-based decision on who is the right fit for you. And at that point, go ahead and create a retirement investment strategy. Build a strategy around what your goals, beliefs, values, and desires are, and then merge in your finances, and that's how you create the one true plan for yourself. Because here are the facts. 97% of Americans do not have a written plan for their finances. We just don't. We'll plan a trip. We'll plan, what we're going to do for the day. But the majority of Americans do not have a clearly defined written plan for their finances. So here's my challenge. Don't be part of that 97%. Be part of the 3%. Be part of the 3% who's built a plan, who understands their finances, who understands where their investments are going to go, and understands how you're going to get there. So here's my offer to you. Schedule a 15-minute call with a member of our team. No obligation, no strings attached. Schedule a call with a member of our team. Have a discussion on what you're looking to accomplish. Have a discussion on what you'd like to see happen with your finances and investments, and see if that individual, our team, is a right fit. And the reality of it is, what's the worst that happens? The worst that happens is that you spend 15 minutes, you talk to somebody, you find out that they're not a fit, or that you need to go call somebody else, or that you're in good shape. That's the absolute worst that happens. But I can promise you this, there's also a best option too, right? The best thing that could happen is that you work with a professional and they give you some clarity. They give you a path. They put you into that 3% that has a clearly defined written plan. And you learn some things that you didn't know, and you put yourself on the right path for retirement. I appreciate you taking the time today. I hope the 25 minutes was valuable for you. And our team looks forward to hearing from you soon. All the best.